Okay, so speaking to ratio analysis, basic ratio analysis should be considered in the same category as PESTLE and SWOT review under Chapter 6. And Chapter 6 is Strategic Management Tools. So we'll come to Chapter 6. So basic ratio analysis shouldn't be a problem. Having looked at the 5 categories in the lengthy chapter financial statement analysis review, we had a lengthy discussion on ratio analysis, so that should not be a problem at this point. So a very useful analytical tool is ratio analysis. It is only a starting point for further analysis, and the vital and critical written commentary with which to impress the examiner is more important than the ratio analysis. So take note, ratio analysis is the beginning, is the basic, but then the written commentary, that's where it has the marks. And that is why in the appendix, no matter what you calculate, no matter the accuracy of our ratios, if you don't make the commentary in form of those headers and subheaders and speaking to the ratios in form of discussion, telling the financial story, then the case study is going to be a flaw. So the written commentary with which you are impressing the examiner or your client is the important part of the ratio analysis discussion. So ratio analysis as a tool prescribes a numerical pathway to be followed in the assessment and review of figures in the financial statement. And candidates must be able to calculate the groups or families of these ratios. So we looked at profitability in detail. We looked at liquidity. We looked at return on capital employed, which is part of profitability. We looked at long-term solvency, talking about the financial structure. We looked at efficiency, looking at asset activity of the assets, and all at speed and with accuracy. We also looked at investment ratios. So those 5 categories, we've spoken to the numbers practically. So ratio analysis permits comparison between the current results and past results of a business. It also permits comparison between the current results and forecasted results of the business. So this is very, very important. So the current and the past, then also the current result and the forecasted results, ratio analysis could speak to them. So we also look at current results of the business and some external or industry benchmarks or standards or averages. So we're looking at our result, comparing it with other companies in the same industry, other companies in the same sector, and that's what ratios speak to. So between the results of a subsidiary also, we could perform ratio analysis between the results of the division, a segment, and that of another one. We could also look at ratio analysis across business segments, revenue streams within the same organization, in comparing them to see their results and their variations and how to explain those variations very practically. We also look between the company under review and a rival or a takeover target. So ratio analysis could be conducted between a company and a rival or a takeover. So we've seen some past questions where the examiner brings an industry average and say this is the average, compute the ratio and compare with companies in this same industry average to see which one is higher and to examine if the company is doing well and evaluate its performance in this respect. So having performed relevant comparative calculation, now your real skill is in explaining what those results mean. Very, very important. So the real skill of financial statement analysis is in explaining what those numbers mean and to evaluate what might have caused any changes in the ratios or fluctuations in the trend. So this is very important. And that is why no matter how accurate your computations are or your numbers, if you don't speak to them and explain what they mean, you cannot pass case study. It's very important. So I can't overemphasize that. And if your calculations are not that accurate, they are less than, but if you're able to come up with a foundation and calculate, even though it's not accurate, are you able to explain the numbers, you will pass case study. So one of the things the examiner complains about is most guys that concentrate on numerical calculations are accurate, but they flop when it comes to this the explanation. So take note of this examiner's report. So what might have caused any changes also in the ratios and the fluctuations and the trend should be spoken to. Wow, that was fast. Ratio analysis is so sharp and short. Okay, so before we move to our test, do you have any questions on the explanation of ratio analysis? Any questions? Or is very clear and succinct? Any questions, Salma? Any question, Julie?
No question.
No question.
Okay, very comprehensive. Well, we'll know. Let's see from the test. All right. Yes, now we'll know if you understood it. How should ratio analysis be viewed in financial statement analysis? A replacement for all other analytical tools. B, a basic tool that must be supplemented with written commentary.
B.
Allow me read all the option now. That was so fast. C, an outdated method that is rarely used today. D, a method only relevant for internal reporting. How should ratio analysis be viewed in financial statement analysis? A replacement for all other analytical tools. B, a basic tool that must be supplemented with written commentary. C, an outdated method that is rarely used today. D, a method only relevant for internal reporting. Okay, so let me go. S said B now, Abi.
Yes.
All right, final answer.
Yes.
Okay, Jay, what's your pick?
Sleep. Where is Julie?
She's here.
Sleep took me just now.
I know.
Because you're quiet. Yes, quiet.
Yeah, she dozed off a bit. What's your pick?
I choose D too.
Okay, I hope you are not copying us.
No, it is clear.
All right.
Yes, it's very clear, really.
Yeah.
Okay, we'll see. Which of the following is not a key category of ratios used in financial analysis? A, profitability. B, liquidity. C, inflation adjustment. D, asset efficiency.
C,
inflation adjustment.
Yes.
No, I wrote B. I wrote, okay, C.
No, take, are you sure it's C? Are you sure it's not
it's
B?
C. It's C.
He wants to take your mark.
I mean, it's something that is very clear.
Final answer.
Yeah.
Yes.
Final answer C. Okay.
Yes.
Right. Okay. Number 3, ratio analysis allow comparisons to be made between a company's past and current result. B, a company's inventory and its production capacity. C, a company's tax rate and its profit margin. D, a company's debt level and its employees' salaries. Ratio analysis allows comparison to be made between.
Julie is about to take our mark.
No, but we'll get it too.
What's your option now? What's your pick?
It's A.
A as well.
J picked A. See how they are saying it so comfortably. All right, we'll see the answer.
Right. Yes.
We'll see the answer. Which of the following is not a valid use of ratio analysis? A, comparing a business result with industry standards. B, assessing trends within different business segments. C, predicting future stock prices with wow, that's so fast. With certain who is saying C, S or G?
S.
Evaluating a potential acquisition target. Which of the following is not a valid use of ratio analysis? Comparing a business result with industry standards, assessing trends with different business segments, predicting future stock prices with certainty, evaluating
C.
Two of them are almost the same thing in the options. Okay, we'll see the result. Finally, what is the most important aspect?
My network was off for number 5. 5. What is the most important aspect after
Okay, no,
calculating?
I've not
We
read
just
it. I'm
started.
just reading it. I
Just
just
started.
started reading it.
B. I don't know if you can hear me. Number 5 is B. This my network
Yes,
wants to
we
show
can
me.
hear you. We can hear
We
you.
can hear you.
Can you hear us? Oh, okay,
B.
maybe she
Network,
can't
don't
hear
do
us.
this.
We can hear you, Salmat. All right, what is the most important
Can you
aspect
hear
after?
me?
Yes, we can. I can hear you. Julie can hear you too. Can you hear us? Okay, maybe you
5,
log off.
B.
Maybe you log off and come back. Log off and come back,
I think she
Salmat.
just did that. She just did that.
Yes, she just went off. Yeah. Okay. So, what is the most important? Okay, you have already picked your answer, right? B.
Yeah. She has picked B too.
Okay. She picked B. You picked B. How come all of you are having the same answers? All right. So let's see the results. Number 1. How should ratio analysis be viewed in financial statements analysis? B. Wow. They both got it. B. Okay. Ratio analysis provides numerical insights but must be interpreted and explained in context to be meaningful. A strong written commentary is required to impress an examiner or client. Exactly. Okay, she's back. All right, can you hear us now, Salmat? Welcome back.
Yes.
Okay, so both of you got number 1.
Quiz.
No, you got number 1. You got number 1 and you gave us.
Did you hear my final answer?
Yes, you gave your final figure, which was B, your final alphabet B for number 5. Yeah, we had you. You weren't hearing us, but we had you. Okay, so number 1 is correct. You guys got the answer. You picked B, and both of you got
Hi,
it.
Julie.
Number 1.
Yes, number 1
Yes.
is B. And you both got it. So number 2.
Of course.
Number 2, how should ratio analysis be viewed in financial statement analysis? B. Wow. Okay. This is number 1. Apologies. Okay, number 2. Which of the following? I was almost happy that you filled it.
Aha.
Got number 2 as well.
Number 2, you got it. Which of the following is not a key category of ratios used in financial analysis? Explanation, the main category C. So you got number 2 correct, C and C. Wow. From the way things are going, you may get all. The ratio analysis allows comparison to be made between the company's past and current results.
Yes.
Wow. I won't be able to sleep this night. Number 4. Which of the following is not a valid use of ratio analysis? Wow. 4C. Now, wow. So you guys are going to get 100% like this. Number 5, B. Oh my God, they did it. What is the most important aspect after calculating financial ratios? B. Oh my God, 100%.
Yes, sir.
Yay!
Yay, 100%.
I'm not teaching good. I'm not teaching good at all. I'm not teaching good at all. Okay, so let's do the last topic now in the next 10 minutes. Let's do the last topic before we shut down for the night. We have like 10 minutes more. Yeah, so let's look at this last session and call it a night. So we're looking at income statement analysis, including the statement of changes in equity. All right, so let's run. So in developing detailed analysis after your ratio analysis, the financial statements, when you do your detailed analysis, key issues in the income statement analysis concern financial results and financial performance. The main questions to be considered here include, what is the trend in revenue? So you look at the trend in revenue when performing your income statement analysis, including statement of changes in equity. So you ask, what is the trend, the growth, upward or downward in revenue? If rising, how was it achieved? If falling, what is the cause? What is the rate of the increase if it's rising and the decrease if it is falling? So these are questions you ask when you are analyzing the income statement or the statement of comprehensive income. You also ask, what is the significant changes in the sales or revenue mix? What are the changes in the revenue streams? What is the effect of the changes in sales mix, and how does it impact overall profitability? Very important. So when you look at some revenue streams, some perform more than some. And when you look at the performance, what is the impact on overall profitability after you've deducted direct and indirect expenses? Important questions to ask. You also ask, what is the overall trend in gross profit? So after accounting for direct cost, you come up with your gross profit. So is it rising over the period, whether it's a 3-year financial or a 5-year financials? Is the gross profit rising? Is it rising in absolute terms or gross profit percentage terms? So you need to ask these questions in your gross profit. So over the period, or over the 3-year or 5-year period, is the gross profit growing? Are the cost of sales growing and depleting the gross profit? So you need to take note of that. Also, are the margins, looking at operating margin, net profit margin, are they the same for different products or different service lines? You need to look at that and analyze critically. What is the pattern of cost against revenue? Looking at the cost of sales, looking at admin and distribution, looking at internal expenses, finance cost, looking at depreciation and amortization, looking at tax. What are those costs against revenue? Are they rising or are they falling? Very important. So from your direct and your indirect cost, please take note of the patterns. Also, what is causing inconsistency or changes in this cost? What is taking them high? What is bringing it low? Take note of it so that you can discuss elaborately in your commentary. Which cost appears to be fixed and variable? So the fixed costs are the ones that don't change, and the variable ones are the ones that change. What is the operational gearing for the business? Is it debt driven or equity driven?
You said don't take hold of that.
Oh, okay. I thought you were making a comment, Salman. All right. So we're talking about operational gearing for the business. What is the operational gearing? Is it debt driven or equity driven? Very important. Are there any material anomalies in any single key cost figure? So when you look at the cost, direct cost, is the inventory or in the cost of sales or the indirect cost, is it very high? Are there any anomalies in any cost? Looking at their size and materiality, you need to point them out at this point. Also, you look at, is the level of operating profit and profit before tax being achieved satisfactorily and stably? So it's very important that operating profit and profit before tax, that's after you deducted this non-cash item movement, which is depreciation and amortization. Is it stable? And is it satisfactory? Is it okay? You also look at, are the profits increasing or decreasing over the particular year? And what rate, at what percentage is the profit increasing each year? So you need to take note of the percentage to understand how the growth is. You also look at, are there any single anomalies in a key cost item? By looking at the growth also, I think I duplicated this slide. Okay, so you also say, is there any consistency between one year and another of the bridging items? The bridging items, looking at inventory, looking at depreciation and amortization. So are there any inconsistency and consistency year by year on these bridging items in the SCI and the SFP? You need to ask, how material are these items? So those inventory items that breach the SCI and the SFP and the statement of cash flow, how material are they? It's very important. So the bridging items include inventory, closing inventory, look at depreciation and profits, net profit. You also look at losses on disposal. So these are the bridging items you need to look at. Also, deferred income. Deferred income is an item, a liability item, is revenue that you recognize, but you have not provided the service. That is what deferred income is. It's a current liability. So How do you recognize deferred income? Impairment of accounts receivables, provisions for bad debt, which is expected credit loss based on IFRS 9. So that's what you are looking at in this income statement analysis. Accruals and provisions. How are these items? Accruals are current liabilities, prepayments are current assets. Look at the tax charge. Is it reasonable? Also, does the dividend policy make sense? The dividend declared, that of preference, that of equity holders, is it also consistent? Very important you look at this. So the above list would enable structured analysis of the components of the income statement in the case study exam. So this is very important. The list is inexhaustive, but these are the pertinent ones and very important ones. And it's important to understand that in financial statement analysis, as well as providing information about the numerical changes, both in absolute over the period and in percentage terms, it is the level of skillful commentary which demonstrate appropriate professional expertise. So your skillful way of writing with the appropriate headers and subheaders. So when you look at the headers from the 1st to the 6th, how you are able to bring into these 6 headers your commentary based on these ratios, looking at what the headers speak to, is a skill you need to practice over time. So it demonstrates your appropriate professional skill when you are doing that. So those headers and subheaders are very important. And when you are talking about maybe professional tools, analysis of ratios, when you talk about your analytical skills, how you're able to talk about these ratios based on those headers is demonstrate how appropriately your professional expertise is brought to bear. Okay, so that will be it for income statement analysis, including the statement of changes in equity. So before we do our quiz, is a short explanation. Do we have any questions on this before we go to our quiz? Any questions?
Already 10 o'clock, no.
All right, so it's already 10 o'clock, so it's good we stop here after our quiz and we'll continue the others in the next class. So, Salmat, I don't know, do you have any questions?
No, sir. No, sir.
Okay, fantastic. So let me
Although
write.
this one is quite good. No problem.
Okay, that means this is very, very.
I really like in equity. I don't know it. I don't like that place of account.
Okay, that statement of changes in equity, right? It's very simple. And the examiner, yeah, it's very simple. The examiner had to test it anyway because it's a short statement. But then let's look at the quiz and see how much you understand the income statement analysis, which is predominantly tested. What is the primary focus on income statement analysis?
Okay, so.
Yeah, what is the primary focus, number 1, of income statement analysis? A, the company's balance sheet structure. B, the company's financial results and performance. C, the company's compliance with tax laws. D, the company's operational policy. Income statements and SOCIE. What is the primary focus of income statement analysis? What's your pick, J and S? Are you guys there?
Yeah.
Are you there? Did you doze off a bit, Julie?
Yeah. Salmat has left.
Oh, okay. Samantha, maybe her network logged her off. She'll come back. So what's the primary focus of income statement analysis? A, the company's balance sheet structure. B, the company's financial result and performance. C, the company's compliance with tax laws. D, the company's operational policies. What's your pick, J?
What is the primary focus of income statement? What's the primary focus of income statement? Company balance sheet. B.
Final answer.
Yes.
B. Okay. When Salmat come back, we'll come back to this question for her. Which of the following factors is not typically considered in income statement analysis? A. Changes in revenue streams and sales mix. B. Variation in gross profit margin. C. Cash flow from financing activities. D. Trend in operating profit and profit before tax. Which of the following factors is not typically considered in income statement analysis? Yeah, Salmat is back. So what's your pick for number 2? Which of the following factors is not typically considered in income statement? Yes, so we'll go back to question 1. Once we look at question 2, we'll go back to question 1 for you. Okay. So let's look at question 2. Yeah, which of the following factors is not typically considered in income statement analysis? A. Changes in revenue streams and sales mix. B. Variations in gross profit margin. C. Cash flow from financing activities. D. Trend in operating profit and profit before tax. J, what's your pick?
Is that for me too?
Exactly, number 2. We're going back to number 1 for Salma.
Okay.
So what's your pick? Salma, what's your pick for number 2?
I'm even confused. I'm trying to remember what is income statement with the way this thing is.
It's not
I'll choose A.
Changes in revenue streams and sales mix. Look at the question again.
Wait, which of the following is not factor? It's not. Sorry, that's not my answer. That's not my answer. Sorry. I thought it was a factor.
2 is C. 2C.
Please wait.
J is speaking C. J, final answer C.
Yes, C. Because this is not cash flow. C.
Let me read it again. Which of the following factors is not typically considered in income statement analysis? A. Changes in revenue streams and sales mix. B. Variations in gross profit margins. C. Cash flow from financing activities. D. Trends in operating profit and profit before tax. What's your final pick?
Yes. Because it's not C. We cannot discuss so.
Okay. Final answer for both of you, C. Okay, so let's go back to number 1 for S. What is the primary focus of income statement analysis? A. The company's balance sheet structure. B. The company's financial results and performance. C. The company's compliance with tax laws. D. The company's operational policies.
That's number 1 again.
Yes, number 1
B.
for S. Okay, B.
Okay.
I'll pick B.
Yeah, all right. So let's go to number 3. Why is it important to assess cost patterns against revenue streams? A. To ensure that all costs remain fixed over time. Huh?
I'm seeing question 2 on the screen. This network. Okay,
it has come. Okay, number 3. Yeah. It has started. Okay, so why is it important to assess cost patterns against revenue streams? A. To ensure that all costs remain fixed over time. B. To determine if costs are rising or falling in relation to revenue. C. To identify tax evasion strategies. D. To calculate the company's market share. Okay, so S said B. Final answer S.
Yes.
Okay, J, what's your final answer?
Final answer is B.
Okay, why is it important to assess cost patterns? Okay, B. All right, we'll see. Number 4, which of the following items is not typically assessed when analyzing the consistency between income statement and the statement of financial position? Which of the following items is not typically assessed when analyzing consistency between income statement and statement of financial position? A. Depreciation and profits or losses on disposals. B. Impairment of accounts receivable. C. Fixed asset revaluation reserves. C. Accruals and prepayments. Which of the following items is not typically assessed? Final answer for S.
Yes.
Okay, final answers.
Not typically assessed when analyzing them.
Which of the following items is not typically assessed when analyzing the consistency between income statement and statement of financial position? A, depreciation and profits or losses on disposals. B, impairment of accounts receivable. C, fixed asset revaluation reserves. D, accruals and prepayments. What's your pick, Jay?
Impairment.
I hope these guys don't score 100% again because the last one was not fun.
I go for B.
Okay, final answer.
Yes.
B, okay.
Payment of
J, S, final answer. C.
So this one is doing somehow. Let's see.
Okay, so B, J, S is C. So finally, why is skillful commentary essential in financial statement analysis? A, because numbers alone do not provide complete insights. B, because professional exams require. You said?
Okay, it has come.
Okay. All right. So let me read again. Why is skillful commentary essential in financial statement analysis? Because numbers alone do not provide complete insights. B, because professional exams require written response. C, because ratios and percentages are difficult to understand. D, because financial statements contain errors that must be explained. Why is skillful commentary essential in financial statement analysis?
A.
Because numbers alone do not provide complete insights. B, because professional exams require written responses. C, because ratios and percentages are difficult to understand. D, because financial statements contain errors that must be explained. So S, final answer A, S. Is that your final answer?
I'm still thinking.
Jay, are you still thinking?
I'm still, because sleep has been, I've been struggling with sleep. You won't believe it. Struggling.
Just hold on. Hold on, we'll soon be through. Just hold on. Tell sleep to give you some minutes.
Okay.
He will soon have his time. He will soon have his time. Why is skillful commentary essential in financial statement analysis? So this is the last one, and you succumb to sleep. A, because numbers alone do not provide complete insights. Because professional exams require written responses.
A.
Final answer.
Yes.
S, final answer.
Yes,
A.
Okay. Drum roll, let's see now. Number 1. Wow, B. What is the primary focus of income statement analysis? Focuses on evaluating financial performance by assessing revenue, cost. Good. So B, both of them got B. Okay. Number 2. Yeah.
Okay, yes, number 2.
Yeah, number 2. Which of the following factors is not typically considered in income statement analysis? C, cash flow from activities. Okay, both of them got it.
Yay.
All right. Number 3, why is it important to assess cost patterns against revenue streams? Wow, B, they both got it. Analyzing cost trends relative to revenue helps determine B. You guys will just have to fail one so that I can sleep well. Number 4, which of the following is not typically assessed when analyzing the consistency between income statement and the statement of financial position? S got it. S got it. BJ failed it. I feel good.
What's the question? What was the question?
The question is, which of the following items is not typically assessed when analyzing the consistency between the income statement and statement of financial position? So the answer is not now. So the answer is not fixed asset revaluation reserve.
I think you picked impairment of account.
No, she picked C. She picked C.
I picked C.
Okay, J picked
I did not. I picked impairment of receivable.
Yes, you picked impairment of receivable, exactly.
What's the answer?
The answer is C, fixed asset revaluation reserve. So it's incorrect because
it's a balance between.
Yeah, incorrect because
asset revaluation, is it not added to the revaluation account for equity? Yeah.
Yes. So revaluation is not a breach because it does not appear in the income statement. It doesn't connect to the income statement and the.
It's not too well assessed when analyzing the question. I don't understand the question.
So we're looking at the bridge like inventory, like receivables, like so revaluation reserve is not a bridge, but you see receivable is a bridge. Receivable is a bridge because so receivable is a bridge because when you are doing cash and credit sales, you are talking of the statement of comprehensive income.
I didn't understand the question.
Yeah. Then when you come to your credit, your current asset, you still talk about receivables there. So impairment of account receivable is a bridge. So I'm glad at least you dropped points.
My goodness, I can't believe it. Oh my goodness.
At least I'll sleep well now. So even though Salmat is going on a very powerful trajectory now, but then let me see the last question. Let me see if she will drop points. Oh, both of you got it. This is not good for Salma.
Yes.
Wow. Salma scored 100 again. This is not good.
Great. Okay. That I even tried with 8 seconds. I've been struggling to stay awake. My goodness. Kai.
Yeah. You guys tried 80%. So Salma just came 20 and she scored 100. Now, wow. Jay has scored 80, 100, 100, 60, and an 80. Wow. That's incredible. Wow. You guys are really doing well, man.
That's nice.
Exactly.
Thank you.
You're welcome. So on Thursday, we'll be looking at thank you. I can see you guys clapping. Thank you. So on Thursday, we'll continue with statement of financial position analysis. I believe Thursday, we should be able to round up on chapter 2 and move to chapter 3.
Thursday is
This study.
Okay, case study. Okay, tomorrow is AA.
Yes, triple A is Tuesday and Friday. So
when are we going to start past questions?
Yeah, so we are start. No, our second mock is on Friday or Saturday. We'll submit Friday or Saturday. Second mock. We've done one mock, so we'll be doing the second on Friday or Saturday. We'll submit the
question for AA.
Yes, on Friday or Saturday. AA and case study is coming on Friday or Saturday, both.
Okay.
Yeah. But we'll have lectures, then we'll submit the question. So we'll use 1 week to answer the question.
Okay.
Yeah. Well, we should be able to finish chapter 2 on Thursday. Let's round off all these theoretical aspects and enter chapter 3 at least. We have overflowed this chapter 2.